To earn $1,000 a month from investments, most people stop listening right there. They hear that number, they think, that's not me, that's for other people, and they click away. But here's what they don't understand. You do not need $200,000 to start. You need a plan that builds toward it. And once you understand how this works, how each pound you invest compounds, how income reinvested accelerates everything, that number stops being intimidating and starts being a target. In this video, I am going to show you exactly how to build a portfolio that generates $1,000 a month in passive investment income. I will show you the 4 income pillars, the realistic timeline it takes, and the exact capital target you need to aim for. No hype, no shortcuts, just the honest framework. If that sounds useful, hit like and subscribe. This channel is built for people who want real financial clarity, not clickbait. Before we get into the specifics, let me show you the structure. There are 4 pillars to this strategy, and the goal is to build income from all 4 simultaneously so no single investment carries all the risk. Pillar 1, dividend stocks and ETFs. Regular income from companies sharing their profits with shareholders. Pillar 2, real estate investment trusts, or REITs, property income without being a landlord. Pillar 3, government gilts and bond funds, stable, predictable interest payments. Pillar 4, high-yield cash and fixed-rate savings, the safe foundation that keeps capital accessible and earning. These 4 pillars together form a resilient income engine. When equity markets drop, bonds and cash hold steady. When interest rates are low, dividends and REITs compensate. They balance each other. Let's talk numbers, because this is where most videos get vague and I want to be precise. To generate $1,000 a month, which is $12,000 a year, you need to know your blended yield. That is the average return across your entire portfolio. Blended yield scenarios, 4.0%, conservative. Capital needed $300,000, $1,000 a month. 5.5%, moderate, realistic. Capital needed $218,000, $1,000 a month. 7.0%, aggressive. Capital needed $171,000, $1,000 a month. 8.0% plus, high risk. Capital needed $150,000, $1,000 a month. For most investors using this 4-pillar approach, a blended yield of around 5% to 6% is realistic and sustainable long-term. That puts your true capital target at approximately $200,000 to $240,000 invested. Honest target: to reach $1,000 a month at a 5.5% blended yield, you need approximately $220,000 invested. That is the number. Build toward it. Now, let's talk about what it realistically takes to get there. And this is the section most channels skip entirely. I need to say something clearly because I think it is important. $1,000 a month from investments is not a beginner strategy. It is a milestone. It is the destination, not the starting line. And if someone is telling you that you can get there in 6 months with the right tricks, they are either selling you something or they are wrong. So let me show you what a realistic journey looks like for someone starting from scratch and investing $500 a month at an average return of 7% per year, which is a reasonable long-term assumption for a diversified portfolio. Time frame, 500 month. Invested portfolio value. Monthly income, 5 years, $30,000, contributed $35,800, 164 month. 10 years, $60,000, contributed $86,500, 396 month. 15 years, $90,000, contributed $160,000, 733 month. 20 years, $120,000, contributed $260,000, 192 month. Note: assumes 7% annual portfolio growth and 5.5% income yield on final portfolio value. At 15 years, you are close. At 20 years, you have passed the target. And here is the important part. These projections do not include salary increases, bonuses, or periods where you invest more. They are the floor, not the ceiling. If you can invest $1,000 a month instead of $500, you reach the same destination in roughly 12 to 13 years. Capital injections, an inheritance, a bonus, a property sale compress the timeline dramatically. The point is this: the earlier you start, the less you need to contribute. Time in the market is the most powerful variable in this entire equation. Start now, even small. This is an authority-building video, and authority means being honest. $1,000 a month takes time, but it is absolutely achievable. And the framework I am about to walk you through is exactly how you get there. Let's get into the 4 pillars. Pillar 1, dividend-paying stocks and ETFs, is the engine room of this portfolio. A dividend is a company distributing a share of its profits to shareholders. You own shares, you receive income. Simple. Many established UK companies pay dividends quarterly or twice a year, with yields ranging from 3% to 7%. For most investors building this type of portfolio, dividend ETFs are the smarter starting point. These funds hold hundreds of dividend-paying companies in a single investment. Instant diversification, lower individual company risk, and still a regular income stream. When choosing dividend ETFs for a UK investor, prioritize funds listed in sterling on the London Stock Exchange to avoid currency conversion costs, and look specifically for distributing funds, those that pay out income rather than accumulating funds that reinvest automatically. Realistic yield expectation from this pillar, 3.5% to 6% annually. On a $60,000 allocation, that is between $2,100 and $3,600 per year, around $175 to $300 every month. Tax tip: hold dividend ETFs inside a stocks and shares ISA to receive all income completely tax-free. The $20,000 annual ISA allowance is one of the best wealth-building tools available to UK investors. Pillar 2 is one of the most underused income sources in UK personal finance: real estate investment trusts. REITs are companies that own and operate income-generating properties, shopping centers, logistics hubs, student accommodation, hospitals. They are legally required to pay out at least 90% of their taxable income as dividends, which makes them exceptional income investments. The advantage over direct property investment is significant. No tenants, no maintenance, no mortgage stress. You buy shares on the stock exchange, the same process as buying any stock, and income is distributed automatically. UK-listed REITs typically yield between 4% and 8% annually, depending on the sector. On a $40,000 REIT allocation at 6%, you are generating $12,400 per year, $200 per month from property, with zero management overhead. Focus on quality when selecting REITs. Look at occupancy rates, tenant credit quality, lease length, and debt levels. The best REITs have long-term, index-linked leases with financially strong tenants and consistent dividend histories. Pillar 3 is the stability anchor: government gilts and bond funds. When you buy a UK gilt, you are lending money to the British government. In return, they pay you a fixed interest rate, the coupon, for the term of the bond, then return your capital at maturity. It is predictable. It is backed by the UK government, and it serves a critical function in this portfolio. When equity markets are volatile, when REITs are falling and dividend stocks are under pressure, government bonds typically hold their value or rise. They are the shock absorber that keeps your overall income stable. You can access UK gilts through bond ETFs available on any standard UK investment platform. Corporate bond funds, lending to companies rather than governments, offer slightly higher yields in exchange for slightly higher risk. On a $40,000 allocation at 4.5%, this pillar generates around $150 per month. Not dramatic, but reliable. And that reliability is the entire point. Pillar 4 is the one people dismiss: and they should not. High-yield savings accounts and fixed-rate bonds form the foundation that makes this entire strategy safe. In the current UK rate environment, easy-access savings accounts and fixed-rate ISAs are paying competitive returns. No market exposure, no volatility, just a guaranteed rate on your cash. The dual purpose of this pillar. First, it generates income from capital that carries zero investment risk. Second, it ensures you always have liquid reserves available, so that if markets drop sharply, you never have to sell investments at the wrong time to cover expenses. Rule: keep 3 to 6 months of living expenses in fully accessible savings before investing heavily. Build on a stable cash foundation, not a leveraged one. Now let's look at a realistic portfolio targeting $1,000 per month, and I want to be fully transparent about what the numbers actually show. Here is a $220,000 portfolio built across all 4 pillars. Dividend ETFs, $75,000 at 5.5%, about $344 per month. REITs, $60,000 at 6.0%, about $300 per month. UK GILTS, bond ETFs, $50,000 at 4.5%, about $188 per month. High-yield cash, ISA, $35,000 at 4.8%, about $140 per month. Total $220, 5.5% average, $972 per month. Yields are illustrative and will vary. This is not financial advice. Close to $1,000. And with reinvested income and continued contributions, you cross that line relatively quickly from this base. To reach exactly $1,000 per month at a 5.5% blended yield, you need approximately $218,000 to $220,000 invested. That is the honest number. I am telling you now so you can plan around reality, not around a headline. Authority over hype. $220,000 is the target at 5.5%. Build toward it systematically. The framework works. The timeline is just longer than most people want to hear. And remember, every step of that journey pays you. At $50,000, you are earning around $230 a month. At $100,000, roughly $460s. The income scales with the portfolio. You do not wait until the end to start benefiting. A quick but essential section on tax efficiency, because the wrapper you hold your investments in can be almost as important as the investments themselves. In the UK, you have 2 powerful tax-free structures to maximize. First, the stocks and shares ISA, up to $20,000 per year. All income and growth inside is completely free from income tax and capital gains tax. For this strategy, where income is the goal, the ISA is your primary vehicle. Second, the self-invested personal pension, or SIPP. Contributions receive tax relief at your marginal income tax rate. That is effectively a 20%, 40%, or 45% government top-up on everything you put in. The trade-off is access. You cannot draw on a pension until age 57 under current rules. But for the long-term compounding portion of your portfolio, it is extraordinarily powerful. Priority order. Max ISA first, $20K year. Pension contributions for tax relief. General investment account for anything beyond that. On platforms, choose providers with low fees, a wide range of UK-listed ETFs, REITs, and bond funds, and a clean interface you will actually use. Compare both percentage and flat fee structures. At higher portfolio values, flat fees become significantly more cost-effective. To summarize everything we have covered today, $1,000 a month from investments is a real, achievable target, built across 4 income pillars: dividends, REITs, bonds, and high-yield cash. The honest capital target is approximately $220,000 at a 5.5% blended yield. The realistic timeline, investing $500 a month, is 15 to 20 years. Less if you invest more, less if you start with existing capital. The key insight is this: every pound you invest today earns income. The journey pays you before you reach the destination. You do not wait for $220,000 to start benefiting. You start benefiting immediately. That is how wealth is built, not in one dramatic move, but in consistent, compounding steps over time. If this video gave you genuine value, if it made that number feel less intimidating and more like a plan, then please hit the like button. It takes 1 second, and it genuinely helps this channel reach more people who need this kind of clarity. And if you want more straightforward, no-hype content like this, subscribe. That is what this channel is about. Like, if this helped, subscribe for more honest finance content. Comment your current investment milestone below. I will see you in the next one. This content is for educational and entertainment purposes only and does not constitute financial advice. Past performance is not indicative of future results. Always conduct your own research and consult a qualified financial advisor before making any investment decisions.